So now, okay, now finally let us start with auditing and assurance. This is paper number 6, okay, and before we start, let me discuss the pattern of the questions that is actually asked in the exam, okay. So in this subject, I hope all of you are aware that we have two parts, okay. The questions will be asked in two parts. The first part is basically 30 marks MCQs. 30 marks MCQs, okay. And the second part, obviously it will be of 70 marks, and the number of questions that are being asked from this part is, okay, 1, 2, 3, 4, 5 and 6, okay. There are 6 questions asked from the descriptive portion of 70 marks, okay. And out of this 6 portion, question number 1, yeah, question number 1, this question is compulsory. Question number 1 is compulsory, and yeah, this question, the category of question is correct, incorrect. Basically, first question, the compulsory question is true and false. There will be a statement given and you have to mention whether the statement is correct or incorrect with reasons, okay. And in this portion, they ask you 7 questions, okay, of 2 marks each. So this question number 1 will carry 14 marks. 14 marks, okay. And that too you have an option. You have to do 7 questions. They will give you an option also. You have to attempt 7 questions out of 8. Out of 8. Alright. So if you can just analyze this, 30 marks is MCQ here, okay. And then we have this 14 marks as true and false also, as correct, incorrect along with reasons, okay. So if you see, in all, out of 100 marks, 44 marks, that means 30 marks as MCQ and 14 marks as correct and incorrect. This is going to be super scoring for you. This can be really very scoring for you if your concepts are really very clear, okay. MCQs, you all know that yes, there can be 1 mark MCQs also, there can be some 2 marks MCQ questions also, there can be a case based MCQ questions also, and then we have true and false of 14 marks, 2 into 7. The best part about these two aspects is that if you solve them correctly, you get full marks, okay. So 44 marks, out of this 44 marks, let's say if you are able to score 35 plus around about say 40, it is going to be really very easy for you to score an exemption in this paper, okay. Earlier, when the concept of MCQ was not there in the paper of auditing, any marks anywhere between 55 to 60, I used to tell the students that yes, it is good marks in auditing, okay. But now with the introduction of MCQs, students have been scoring 70 plus in this subject, okay. Alright, now let us discuss about the remaining questions, okay. Out of question number 2, 3, 4, 5 and 6, okay, you have to attempt any 4 questions, so they are giving you an option, okay. You have to attempt any 4 questions, and each of these 4 questions, the 4 questions that you attempt, the current pattern in which ICI is asking you questions is in the form of 4. This one part, let's say question number 2, it will contain 4 parts. First part, let's say, of 4 marks, second part also of 4 marks, then they are going to ask you a 3 marks question and then again a 3 marks question, okay. So this way we have to take up 4 questions out of the given 5 questions, okay. So this is the entire pattern of this particular paper. Fine. Alright, again I'm telling you, we are going to focus immensely on the concepts part, okay. And if the concepts are really very clear, we are going to focus, we are going to basically score amazing marks, especially in this portion, okay. Now how are we going to start with the paper? As I told you, I will be discussing very basics of the entire paper, okay. We are going to discuss chapter wise, and then we are also going to discuss many questions that have been asked in the previous exams and all. So if you have the study material, you can see at the end of each chapter we have different questions that have been already asked in the past exams, or the questions have been taken from RTP and all. Okay. All right. So I hope the pattern of the paper is clear to you. This is the current scenario. All right. Now, coming to the name of this subject. All right. So auditing and assurance. Auditing and assurance. Okay. See, there are two words here, auditing and assurance. Again, before starting with the subject, I think let us understand the meaning of these two terms, so that you at least get to know what are we going to overall basically study in this particular subject. All right. So the name is, let us split the names into two parts, auditing and assurance. Okay. Now, auditing, the general meaning of the word auditing, the generic meaning, if I say the generic meaning, if I go with the generic meaning of the word auditing, what does auditing mean? Can anyone answer? What does auditing mean? Yes, since it is a live class, I would want all of you to reply and basically be interactive. Yes, what does the word auditing mean? The generic meaning. No one is willing to answer. Am I audible or not? At least answer this. Yes, okay. All right. Alright, so generic meaning of the word auditing means that to examine something. Okay, auditing generally means that we have to examine something thoroughly. Examine something thoroughly. Okay. Now, in this particular subject, we are going to understand auditing of financial statements. We are basically going to examine thoroughly the financial statements of a company, of an entity. So in our subject, in our CA intermediate subject, when I say auditing, I would always mean auditing of the financial statements. Okay, so I say auditing of the financial statements. All right. So I told you that generic meaning of auditing is just to check something, just to examine something thoroughly. But in our CA intermediate subject, we are not going to focus on different aspects of auditing. Rather, our focus will be only on auditing of the financial statement. Okay, so now, in order to understand auditing of financial statements, first let us understand what financial statements mean. Okay, let us first understand what financial statements mean. Okay, now, but again, before discussing what financial statements mean, okay, I would want all of you again to have a look at the basically index also of the of your book, the contents part. Okay, if you can see here, I have basically divided the entire syllabus into 14 chapters. Okay, but in your institute's material, you are only going to find 13 chapters. Okay, now if you can see, I have given chapter 0 also here, which is by the name of fundamentals, the fundamentals. Okay, now chapter 0. Today we are only going to discuss chapter 0. Okay, this is the fundamentals. In this chapter, basically we are going to discuss some important terms, some basic terms, like just I was about to take the term of financial statements. Okay, so we are going to discuss some basic terms here. Okay, which the terms will be used in all the other chapters. Some common terms which will be used in all the other chapters. Okay, now am I audible or not? Yes, yes. No, yeah. I just, I think some issue with my network. Am I visible? Am I audible now? Yes, okay. All right, okay. Okay. So yes, as you all can see, we have 14 chapters in our index, but again I'm telling you, chapter 0 is fundamentals. We are going to understand some terms, some important terms here, some common terms rather I should say, that we will be using in all the other chapters. Okay. So I feel I feel it is important that first we understand some basic terms, and probably then it is going to be very easy for us to understand all the remaining chapters. Okay. Now, along, as you all know that in this subject auditing, just like accounting standards we have for preparation and presentation of financial statements, the management uses accounting standards. Okay, so similarly when we audit, we have to follow some auditing standards, some standards on auditing. So with each of these chapters we are going to understand the relevant standards on auditing also. Okay, so we have chapters from chapter number 1 to 13, and the relevant standards on auditing I'll cover along with the chapters. Okay, and some standards which will be left, basically we are going to cover at the end, basically in chapter number 14. So standards on auditing, if you can see, I have named the chapter as standards on auditing other than those covered in the above chapters. Okay, so we'll try to cover maximum standards along with the chapters, but towards the end of the syllabus we are going to cover few more standards which we will not be covering with individual chapters. Okay, so if you compare this with your ICI module, in your ICI module you will only find chapters 1 to 13, but as something extra we are going to understand the fundamentals first. Okay, now this fundamentals, this is only for the purpose of your understanding. Once you understand the concepts, you don't have to go through the chapter again and again. Okay, I have told you this, that in the chapter of fundamentals which we are about to begin shortly, we are only going to discuss few terms which are relevant for the upcoming chapters. Okay, all right. Now coming back to the name of this subject. Okay, I've just told you that auditing means to examine something thoroughly. Now in this subject I told you this, that we are going to audit basically the financial statements, auditing of financial statements. So now, in order to understand auditing of financial statements, let us first understand what financial statements means. Okay, so I want all of you to come to this chapter of the fundamentals. We are starting with chapter number 0. Let us start with the chapter fundamentals. Okay, all right. Now in the chapter of fundamentals, if you can see, I have given the heading as audit terminology. Okay, and again I've told you this, that we are going to understand certain terms which are going to be used repeatedly throughout the syllabus. Okay, so I am starting with the term financial statement first. Financial statement, I just told you that in this subject we are going to do auditing of financial statements. So let us understand the term financial statement first. Okay, now all of you know this, that the term financial statements refer to a statement containing financial information. The financial statement means it is a statement, it is a document which contains all the financial information of an entity. And you all know this, that financial statement generally includes what? It includes a balance sheet. Okay, it includes a statement of profit and loss, it includes cash flow statement, it includes a statement of changes in equity, especially for the listed companies and all where Ind AS is applicable, statement of changes in equity, and finally we have something called as notes to accounts and other explanatory material. Okay, so these are the 5 things which are generally included in financial statements. What are the things? A balance sheet, a statement of profit and loss, a cash flow statement, statement of changes in equity, and then we have notes to accounts. Okay, so we are going to actually audit all these things. We are actually going to audit the financial statements. Now, one important question I would like all of you to answer this is, see, we are going to learn auditing here. Okay, but you have to understand this, that the responsibility of preparation of financial statements, the responsibility of, let's say, preparation and presenting of the financial statement, it is not of the auditor. It is of the management of the entity. The management is responsible for preparing and presenting the financial statement. The management is responsible for the preparation and the presentation of financial statements. Okay, so one important term that you have to understand here is responsibility for preparation and presentation of financial statement is that of the management of the enterprise. Fine. Okay, so this is what financial statement means. Okay, now We have financial statements. The management, I just told you that the management prepares and presents the financial statement. So what is the purpose of preparing the financial statement? Why do they put in so much efforts to prepare the financial statements and then get it audited by an auditor? Okay, so we have financial statements, and then we are going to now understand that these financial statements are used by some users. Okay, these financial statements are used by some users. Okay, now let us understand who can be the users of financial statement. Why do management prepare the financial statements? These financial statements are ultimately used by whom? Okay, so the next brief concept, very light concept that we need to understand is who are the users of the financial statement. Who are the users of the financial statement? Okay, so now I just told you that the management, they prepare the financial statements. Now, can they themselves be the users of financial statement? Yes. See, in an organization, let's say I am the owner, I am, let's say, the management of the company. Okay, now I prepare the financial statement so that I get to know the position of my company, whether let's say till the month of September, have I made any profits or not, what is the position of my total assets, total liabilities, what is my net worth. Okay, so management no doubt prepares the financial statement, but they themselves are one of the users of financial statement. Okay, now first point, who are the users of financial statement? The management itself, the management themselves are one of the users of financial statement. Now, why do they use the financial statement? For day-to-day decision making and performance evaluation. They'll get to know, okay, whether they are performing well or not, whether they are making any profits or not, for performance evaluation. Okay, so please remember this, that it is the management who is responsible for the preparation and presentation of financial statement, and at the same time they themselves are the user of the financial statement, because they need to make day-to-day decisions and also to evaluate the performance of the organization. Okay, so one of the users is management. Now, second, the owner, the proprietor, or the shareholders. Okay, now the shareholder, the owners, they also can be the users of the financial statement. Now, in a company, all of you know this, that the shareholders put in their money in the company. Okay, and the company is run by, let's say, the directors, and the management is different. The shareholders, because they invest their hard-earned money, let's say, in a company, they would always want to know how the company is performing. They would always want to know the affairs that are being conducted in the company. Okay, so the owners, the shareholders, they basically are one of the users of the financial statement. They analyze the performance, profitability, and the financial positions of the company in which, let's say, they are the owners or they are the shareholders. Okay, and third is employees. Do employees also see the financials? Yes. Now, see, the employees, let's say I am an employee of a company, I would always be interested in knowing whether the company is growing or not, whether there are adequate, let's say, whether the sales, whether the revenue or the turnover, I can say, whether it has increased or not. Okay, why would I as an employee be interested in knowing this aspect? Because if the company grows, let's say, then only I can foresee my growth potential. Okay, if the company goes, the probability of me growing in the company would also be high. Okay, no employee would want to work in a company which is not performing well, because if the company doesn't perform well, obviously the employees will not be paid well. Okay, so as an employee, the employees are also one of the prospective users of the financial statement. They assess the growth prospects. All right. Okay, now then we have these 2 points we are going to understand together, the lenders and the suppliers. Okay, now let us say we are a company XYZ Private Limited. Okay, I want to buy a machinery or worth rupees 5 crores, let's say. Okay, I will approach the bank for a loan. Okay, now the bank manager is not going to give me loan just seeing my face. Okay, that okay, I am the director of the company. Okay, you being a director, you have come to our bank. Okay, I'll give you 5 crore loan. This is not how things work. Okay, now the bank manager, obviously he is going to ask me for certain documents. He is going to assess. The first thing probably which he is going to ask me is for my financials. Okay, he is going to ask me for my financials. By going through the financials, he is going to assess whether this company has the repaying capability. If the bank grants loan to this company, whether this company in future will be able to, let's say, generate revenue. Okay, generate enough revenue so that the company is able to pay the installment, the principal and the interest to the bank or not. So bank would always be basically interested in knowing our financial positions, the present position as well as the prospective, the future position, let's say 3 years, 5 years down the line. So even sometimes we even need to give them projected financial statements as in if the bank gives us the money in the year 1, this is how we are going to utilize the money, year 2, this is what is going to happen. Okay, so the bank, before obviously it grants us any credit, they are going to assess the financial statements. Okay, now similar is the case with suppliers. I have a supplier from whom, let's say, I buy raw materials. Okay, now if I am a first time, let's say I am this is a supplier, okay, and I am the person, let's say XYZ Private Limited. Okay, now if we are making a transaction, let's say for the first time, okay, now I want the supplier to grant me credit, I want to buy the raw materials on credit. Obviously the supplier will be a bit hesitant in giving me the raw materials, in supplying me the goods on credit. Okay, but because let's say this is the industry trend, everyone is buying and selling on credit. Let's say in our industry credit works a lot. So probably the supplier is going to ask me for my financials. He is going to see how strong an entity I am. Okay, only if he is, let's say, confident in our company by going through the financials. Okay, he is going to basically extend us credit. He is going to give us raw materials on credit. Okay, so similar to lenders, the suppliers also need to assess our financial position before they can extend credit to us. Okay, so the lenders, they determine the financial position and strength of the entity. Suppliers to determine the credit worthiness of the company in order to give credit. Okay, all right. Now, 6th point is customer. The customer also basically is interested in your financial statements. Now let's say this was our supplier here. He is the supplier here. Okay, we have one customer here. Okay, now the customer basically, let's say, comes to XYZ Private Limited and he negotiates for some, let's say, a deal. Okay, now both of them are negotiating, but before basically the deal is finalized, the customer would always want to ensure, the customer would always want to be assured of that this XYZ Private Limited, will it be able to fulfill its order or not? Will it be able to deliver the order in time or not? Okay, so the customer also, before entering into any long-term contract with XYZ Private Limited, would want to ensure whether XYZ Private Limited has the capability to fulfill all the requirements, all the demands, all the orders of this particular customer. So even the customers are one of the users of the financial statement. They'll see the financial position of the organization and accordingly probably they'll strike a deal with the company. Okay, so yes, the customers are also one of the users of the financial statement. Now we have government also as one of the users. Now can anyone answer this, that how is the government one of the users of the financial statements? Now government, basically you have to understand this, that in order to assess whether you have paid the right amount of tax or not, okay, the government may ask for your financial statements. And with the income tax return, if you are a business entity, you need to upload your financials also. You need to upload the details of your balance sheet, your PL. Okay, so ultimately government is one of the users of the financial statement. Now to ensure prompt collection of both direct and indirect taxes. So the main reason why government seeks for your financials is for the to assess whether you have paid the right amount of tax or not. Okay, now 8th point is prospective investor. Now we had shareholder, he has already invested in the company. Now we have another point, prospective investor. Now prospective investor is one who is basically who has not yet invested in the company, but he wants to make one investment. Okay, so let's say before I put my hard earned money in any of the companies, in buying the shares of a particular company, I would always want to go to the fundamentals of the company, whether the company is strong or not, how is the company performing currently, or so all these data, all these details, obviously I'll get to know all these details through the financial statement. So prospective investors are also one of the users of financial statement. So to assess the solvency and future prospects of the organization, they use the financial statements to understand whether it is a going concern, whether it is going to, obviously the solvency of the company, the future prospects of the organization. They understand all these aspects using the financial statement. Okay, then we have another point number 9, the scholars and the research analyst. Now You must have seen in lot of, let's say, in our in newspapers and in some of the online portals, that they compare two companies, they compare the financials of the two companies and all. So there are a lot of scholars and the research analysts who use the financial statements to make comparison. Let's say we are doing a comparison of Reliance Industries of 2020 with the data or the figures of, let's say, 1990, and then they'll show you the growth prospects and all. So researchers, the scholars, they also use the financial statement. Okay, so for study, research, advising prospective investors, etc. All right, so now what have we covered? I taught you that what financial statements means, and then there are users of financial statement. There is financial statement, and then there are users of financial statement. Now if you go through the users in detail again, the first 3 points, the first 3 points are basically internal users. Internal users, the management, the owners, the proprietor, or the shareholders, or the employees. These are all the internal users. Okay, and from point number 4 to 9, the users are basically external to the organization. The lenders, the suppliers, the customer, government, prospective investors, the scholars, the researchers. Okay, all these are external to the organization. Now, why I have discussed financial statements, again the users of the financial statement. Okay, now let me discuss one aspect with you. All right, okay, now let's say this is a person here, an individual. Let's say his name is Mr. Ram. Okay, and this person goes to a bank, let's say HDFC Bank. Okay, this person wants a loan of, let's say, rupees 1 crore from the bank. Okay, all right, so he goes to the branch manager, he goes to the branch, he talks to the branch manager, and the branch manager basically tells him all the requirements that he needs to fulfill in order to avail the loan of 1 crore. The bank manager asks Mr. Ram for his financial statements. The first thing which the bank manager asks is for the financial statements. Okay, all right, now the next day, having understood all the requirements, let's say, Mr. Ram, on the next day, he goes to the bank again with the financial statements, and he gives the financial statements to the bank manager. Okay, now my point to all of you is this, that let's say Mr. Ram, he has drafted the financials which he has drafted, the balance sheet which he has made. He has drafted an excellent balance sheet. He has shown his position to be really, really very good, so that the bank basically trusts Mr. Ram. Bank basically will assess that, okay, yes, the financial position of Mr. Ram is superb, and if they extend credit to Mr. Ram, if they give a loan of 1 crore to Mr. Ram, basically the bank is not worrying at all, because of the financials of Mr. Ram, which he has portrayed as excellent. Now HDFC Bank is also very happy that yes, we have got a very good customer. He is not going to run away with all our money. So even if we give him 1 crore loan, we are doing a good business, because seeing his financials, it is pretty obvious that he has the repaying capability. He will be basically repaying us with our, obviously, the interest and the installment. Okay, so he's not going to be like Vijay Mallya and all. So bank is also very happy. Now again, this Mr. Ram, again, in this very same year, let's say this is financial year 1920. Okay, he prepares this financial statement. Let me call this as V1. V1 is version 1. Okay, wherein he portrays that his position is excellent. Just a hypothetical situation I'm taking. Okay, again this Mr. Ram. Okay, let's say he goes to the income tax department, or the income tax department calls him. Okay, he goes to the income tax department, and there also is asked to produce the financial statements, and he produces a financial statement of the same year. Okay, but this is altogether a different version. In this particular financial statements, he has shown that he is not being doing good in business. Okay, there are losses consistently, and because of the losses, there is no tax liability as such. Okay, so he basically portrays here that he is a very poor entity. Okay, they are not performing well. Now for the same financial year, see how smart is Mr. Ram. For the same financial year, he has prepared two versions of the balance sheet, version 1 and version 2, to basically satisfy the needs of different users. Now this can happen, right? This can happen. Now, in this case, obviously, Mr. Ram is, let's say, not very honest, not an honest person. He has created two versions of his financials just to satisfy the requirements of bank, or let's say he doesn't want to pay taxes, so he's portrayed his entity to be very poor. Okay, he's formed two versions of the financials in the very same year. Okay, now let us assume that Mr. Ram is also very honest. He's honest. Okay, and whatever financials he gives one version of the financials to both the users, to the bank as well as to the income tax department. He gives only one version. This is case 2. He gives only one version of the financial statements for the year 1920. Okay, let's say even if Mr. Ram is very honest, okay, don't you think there can be some mistakes in the financial statements prepared by him? Obviously, there can be some mistakes. He might miss out doing some entries. Okay, he might basically show some assets as liabilities. He might overstate some assets. I can say he did not do all this intentionally, but out of carelessness, due to human nature, let's say some mistakes might be there in the financial statements. Now, the entire scenario which I have discussed now, what is the whole point? What is the whole point of discussing this example? Please understand. Now, when Mr. Ram gives the financials to HDFC Bank, okay, my question to all of you is that will the bank manager trust the financial statements? Will the bank manager have faith in the financial statements which actually has been given by Mr. Ram and it has been prepared by Mr. Ram only? Will the income tax department have faith in the financial statements prepared by Mr. Ram? Okay. The question is, this HDFC Bank, the income tax department, they are not going to place reliance on the financial statements given by Mr. Ram, prepared by Mr. Ram. They are never going to trust the financial statements which is prepared by Mr. Ram. Okay. You just imagine a situation in a country like India where your 10th mark sheet, your 12th mark sheet, your CA foundation mark sheet, the photocopies and all, if you do, no department accepts the photocopies without the signature of a gazetted officer. They are not accepting your 10th mark sheet without a signature, without a gazetted officer's signature. How on earth do you think that a bank manager or the income tax department will place reliance on a financial statement worth crores of rupees? They are never going to place reliance on this financial statement. Okay, let's say I told you, let's say even if they know that Mr. Ram is very honest, the income tax department also knows, the HDFC bank manager also knows that Mr. Ram is really very honest person. He is not going to indulge in any kind of fraud, etc. Okay, whatever he has shown in his financial statements is correct. Okay, but still Mr. Ram, I told you this, out of, let's say, carelessness, okay, out of, let's say, some mistakes only, out of, let's say, lack of knowledge of accounting standards, he might commit some mistakes while preparing the financial statements. Okay, so again, please see, this is the management. Okay, he prepares financial statement. These are the users. Okay, so there is financial statement, there are users of financial statement, but there is a problem which all of you can see here is that the users will not be able to place trust or reliance on the financial statements. Okay, so what has to be done now? What can be done now? This problem, it arose across the globe. Okay, that how do we trust the financial statements which management themselves have prepared? I just told you that when I was discussing financial statements with you, I told you this, that the responsibility of preparation of financial statements is of the management. Okay, so how will the bank manager, how will the income tax department trust the financials which has been prepared by the management of the organization? So there was this problem. Okay, to resolve this issue, the profession of auditing came into existence. Okay, now what happens in auditing? There will be a person who will be known as auditor. Okay, he is basically going to assess the financial statements. He is going to see the financial statements, okay, of the organization, of the entity, and he is going to see whether all the aspects in the financial statements which are prepared by management is correct or not. If he sees that yes, everything is correct, along with the financial statements, he is going to issue his report, and he is also going to sign on the financial statements. Now, when the financial statements are signed by an auditor, let's say a chartered accountant, okay, obviously the HDFC bank, the income tax department will now be able to place reliance on the financial statement, because it has been evaluated by another person who is known as auditor. Okay. In the earlier scenario, what was happening? In the earlier scenario, the financials themselves were prepared by the management and it was straight away presented to the bank manager. But now what is happening is, the bank manager will tell Mr. Ram, no, I cannot rely on this financial statements. Go get this financial statements audited by a chartered accountant. Okay. Now, when Mr. Ram gets the financial statements examined, audited by a chartered accountant, whom we call as auditor, HDFC Bank will now be able to place reliance on the financial statements. HDFC Bank now will be able to place reliance on the financial statement. The income tax department will now be confident, will now it will enhance the degree of reliability which they basically place in this financial information now. So what I'm trying to say here is, try and understand that this auditing, once the auditing is done, once the auditing of financial statements is done, it provides users with a certain degree of confidence. It provides the users of the financial statement certain degree of reliability. Now obviously they can place reliance on the financial statement. So now this confidence, this enhancement of reliability, it is called as assurance. The users of the financial statement are going to get assurance when the financial statements of the company will be audited. So when I say auditing of financial statements, can I now say that assurance is an outcome of auditing of financial statements? Yes. Assurance means what? That the confidence in the financial statements which will now be placed by the users of financial statement will be very high. So auditing gives assurance to the users of financial statement that whatever is mentioned in the financial statement is somewhat correct. Okay. So the users will have assurance. So this is the meaning. What I have just told you is the meaning of the two terms, the word, the subject. Okay. Your subject's name is auditing and assurance. Okay. Now I told you this, the outcome of auditing is what? Assurance. Okay. Assurance in simple terms, again, if I say assurance means confidence to the users. It is going to give confidence to the users that whatever is written in the financial statements is somewhat correct. Now, is this clear to everyone? Yes or no? Yes? Okay. Now, so we have just covered what is financial statements. We have covered who are the users of financial statement. Okay. Now, let us understand few more terms in this chapter. Okay. Now, we have a word financial reporting framework. Financial reporting framework. I will be referring to this word as FRF. Okay. It will be used almost in every chapter of our subject. FRF. Okay. Now, I just discussed with you that it is the management who is responsible for the preparation and presentation of financial statement. Now, can management use any method or any format of preparing the financials? No. The answer is no. Management, they cannot, I can say they cannot randomly use any format of the financial statement. Okay, the format, the presentation of the financial statement, how is it going to be presented? It is all they have to follow certain rules and regulations while they make the financial statements. Okay, so these rules and regulations with which management will follow for the preparation and presentation of financial statements are termed as FRF, Financial Reporting Framework. So what is Financial Reporting Framework? Financial Reporting Framework is nothing but set of rules and regulations. Please mark this word, set of rules and regulations that are to be followed for preparation and presentation of financial statements. Now, what can be the set of rules and regulations? Now, if I talk about a company, okay, can a company make their financials in T form? Can they make a financial statements in, let's say, balance sheet in T form? No, this is not allowed. Okay, why? Because the management, while preparing the financials of a company, they have to follow certain rules and regulations. They have to comply with, let's say, Schedule 3. They have to follow some AS also while making the financials of the company. Okay, so Schedule 3 of the Companies Act they have to follow. They have to follow accounting standards also. If it is, let's say, a listed company, probably they might have to go for Ind AS. Okay, let's say the company is somewhere in US, then probably they might have to follow US GAAP. Okay, the company might also be following IFRS. Have you heard all these names, right? These are basically the framework these are basically the set of rules and regulations which management has to use when they prepare the financial statement. We call it as financial reporting framework. Okay, so let me summarize it again. Management, they cannot use any particular method. They cannot randomly choose any format of financial statements. They have to follow certain set of rules and regulations. Okay, so these rules and regulations are called as FRF. All financial statements are prepared in accordance with financial reporting framework. Now, few examples can be, for example, in case of a company, the applicable financial reporting framework is Schedule 3, the accounting standards. If you want, you can write all these examples also. The US GAAP, generally accepted accounting principle, IFRS, you must have heard about all this, IFRS, Ind AS, all these are basically the financial reporting framework. Is this clear? So I told you this, that management is responsible for preparing and presentation of financial statements. Now again, they have to use all this FRF while they prepare the financial statements. They cannot just randomly prepare the financial statements. They have to follow this financial, whatever FRF is applicable to them. Alright. Okay. Now, we have covered financial statements. We have just discussed users of financial statement. I have also covered what is financial reporting framework. Now let us understand the word auditing, the name of this subject. Let us understand the word auditing. Okay, I hope you are clear with the word auditing and assurance. Can I say that assurance is outcome of auditing? Can I say this, that assurance is outcome of auditing? Yes, okay, all right. And this assurance, who is getting the assurance? Who is getting the assurance? The users of the financial statement. Users can be any. Users can be, I told you, shareholders, management, lenders, suppliers, customers. Everyone will get an assurance if the financial statements are audited and signed by an auditor, a chartered accountant. Okay, all right. Now, what is auditing? Let us understand the word auditing now. What is auditing? Okay, so let me just read the definition first. Okay, and this definition we are going to read it in chapter 1 also. Obviously you'll be able to learn this definition. We'll be repeating it quite a number of times here. Okay, so what is auditing? An audit is, it says, independent examination. It is an independent examination of financial information of any entity. Okay, independent examination of financial information of any entity, whether profit oriented or not, and irrespective of its size or legal form. It can be any entity, whether it is profit oriented or not, or irrespective of its size or legal form, when such an examination is conducted with a view to expressing opinion thereon. This is a huge definition. Okay, let me read this again and then we are going to interpret the definition. So it says auditing is an independent examination, okay, of what? Of the financial information of an entity. Now this entity can be profit oriented or not. It can be of any size or legal form. Okay, why is this examination conducted? When such an examination is conducted with a view to express an opinion, with a view to express an opinion thereon. Thereon means with a view to express an opinion on the financial information. Again, let me read the definition. Auditing is basically what? Independent examination. Independent examination of financial information of an entity, whether profit oriented or not, and irrespective of its size or legal form. Why is this examination conducted? This examination is conducted with a view to express an opinion. Express an opinion thereon. Thereon means express an opinion on the financial information. The auditor is going to express an opinion that yes, the financial statements, let's say, is okay, it is correct. I'm just basically using some layman terms here. We are going to understand the technical terms also later. Okay, but he basically audits, he checks the financial statements in order to express an opinion that yes, the financial statements are, let's say, correct. Okay, now let us understand each of these terms here, each of the words. First is audit is an independent examination. It is an independent examination. Now let us say this is an entity, XYZ Private Limited is an entity where I am the auditor, where I have gone to audit. Okay, but in this entity, the director of this company, let's say the director of the company is my father. There are two directors, one is my father and the other director is, let's say, my mother. Okay, and now because I cleared chartered accountancy, okay, they told me that you only audit our company. Okay, now if I go and audit, if I go check the financials of, let's say, XYZ Private Limited, do you think Will I be able to act independently? Will I be able to act with objectivity here? Don't you think, obviously, even if there are some mistakes or let's say some fraud committed by my father, I'll never be able to pinpoint them. I'll never be able to basically give in my report that there is let's say a fraud of this amount, the financials are not correct. I'll never say this. So am I independent here? No, I am not independent. I am not at all independent here, because I am being influenced, I am being bound by the relationship which I share with the directors here. Okay, so basically this is not auditing. Okay, this will not amount to auditing. Auditing has to be independent examination. I should be free from any kind of biasness. I should be as independent as possible. I should not be related to the company, to the directors, to the members of the company. It has to be an independent examination. Okay, if I am independent, then only obviously I'll be able to check the financials without any kind of biasness, okay, without any kind of influences. Okay, so just remember, auditing is an independent examination. It is an independent examination. Now again, discussing this word. Okay, let's say there's a cricket match going on between India and Pakistan. Okay, so and sometimes let's say if India is not performing well and the umpire is also from Pakistan, okay, obviously what is going to happen, we might not like it and we might blame it on the umpire, that the umpire is not giving correct decisions. This was not a case of LBW, let's say he just gave it out. Okay, the umpire is biased. We may come out with these kind of judgments. Okay, so obviously now what happens is this was actually happening before 2000s. Okay, there was no rule as such by ICC that in a match the umpire can be anyone. This was the rule basically. Then post 2000 they came up with this aspect that if India and Pakistan, let's say they are playing a match, the umpire is always going to be from some third country to ensure independence. Okay, now because let's say if the umpire is from Pakistan, obviously he might be somehow inclined towards the country. Okay, so in this case the umpires were not independent, so ICC came up with this new policy that the umpires will be from an independent country. Similarly here also, the audit is basically independent examination. The auditor should not be connected with the entity. He should be free from influences. He should not be biased. Okay, so it is an independent examination. Now it says independent examination of financial information. Now what do you mean by financial information? Okay, now please understand this, that we ultimately have to check the financial statements. We ultimately have to check the financial statements, and the financial statements consist of what? It consists of, we have already gone through, it consists of balance sheet, the PL, the cash flow statement will be there, the statement of changes in equity. Okay, then we have notes to accounts. Okay, now we have to check all these aspects. All right, now in order to, let's say, check balance sheet and PL, okay, now these balance sheets and PL, how do you think they are prepared in the organization? Okay, you know the accounting cycle, right? There will be some source document, okay, on the basis of which entry will be made into the accounts, entry will be made into the systems. Now source documents, let's say it can be an invoice, it can be a voucher. Okay, so from here the entries are going to be posted, let's say journal. From the journal it is going to go through the ledgers, you all know this. Okay, from the ledgers then the trial balance is made, and from the trial balance obviously the financial statements are prepared. Okay, now we have to check this financial statements. Okay, now let me tell you this, that let's for example I say that I want to check traveling expenses of 1 lakh rupees in the PL, traveling expenses of 1 lakh. Okay, so if I want to check the traveling expenses of 1 lakh, I would be basically asking them, okay, how did you make this entry? They'll probably show me some invoice, then the journal, then the ledgers. Okay, so when I say I am going for an audit, it means that I need to examine all the underlying information, also all the underlying documents. I might have to examine them. Okay, so that is why the definition says audit is an examination of, it says it is an independent examination of financial information. By financial information I mean all the source data and the underlying documents, the source data, or I can say underlying data. Underlying data means, the source data means these data basically were used to create the financial statement. So I am going to see the source data, the underlying data, the vouchers, the invoices, everything, the ledgers, all this will be my financial information. Okay, so audit is independent examination of financial information of any entity. It can be any entity, it can be a company, it can be a partnership firm, it can be an LLP, it can be a trust, it can be a society, it can be an NPO. Okay, section 8 companies, you know. So audit is independent examination of financial information of any entity, whether profit oriented or not. Okay, their intention might not be to earn profits. It can be an NPO, not for profit organization, and irrespective of its size or legal form. Irrespective of its size of legal form, size as in it can be a very large company, it can be a very small company also. Audit can be done for any entities. Okay, or legal form. Legal form I've already discussed. It can be an LLP, it can be a partnership firm, it can be a company, it can be a trust. Okay, so 3 words: independent examination of financial information of any entity. Okay, now when such an examination, this is a very important line here, now when such an examination is conducted with a view to express an opinion thereon, this auditing examination of financial information is done ultimately to express an opinion on the financial statements. Now, generally, what opinion do we give on the financial statements? That yes, the financial statements are, let's say, okay, the financial statements are correct. Okay, so let's say this is the opinion we are giving. Now, when such an opinion is given, when such an examination is conducted with a view to express an opinion thereon means on the financial statements. Now, a very important word that you have to understand is opinion. Let us understand the significance of the word opinion here now. Okay, now please understand this, that whenever an auditor is auditing the financial statements of an entity, he is only going to give an opinion on the financial statements. Opinion on the financial statements. Okay, now what do you mean by the word opinion? Opinion means my point of view, that according to me the financial statements are, let's say, fair, the financial statements are, let's say, true, they are giving a true view, they are correctly made. Okay, so financial statements, when an auditor audits the financial statements, he gives an opinion on the financial statements. Opinion, please understand that opinion is different from the word certificate. He is not going to issue a certificate. He is not going to write a certificate and say that the financial statements are correct. He is only going to give an opinion. By opinion, I mean one's insight. Okay, one's point of view. If I say that yes, I feel the financial statements are okay, this is my point of view, this is my insight. Okay, and when I say I'm giving opinion, this means that your insight may be totally different. Let's say I am an auditor and there is another auditor. Okay, the other auditor may feel that the financial statements are not correct, but I am feeling that yes, the financial statements are correct. Now this is the difference between opinion and certificate. When I give a certificate, this means whatever is written in the certificate, whatever I have written in the certificate is correct, is 100% correct. There is no second thought about it, there is no doubt about it. Okay, but when I give an opinion, it is just my opinion. Okay, a different chartered accountant can have another opinion. Okay, so this is a difference. Please understand, once the audit is done, the auditor will give his opinion. He is not going to give a certificate. When I say certificate, it means the contents, whatever is written in the certificate is 100% correct. There is no second thought about it. But this is not the case in auditing. In auditing, the auditor only gives an opinion. Okay, now try and understand it in this way. Okay, let's say the 10th mark sheet that you get, the 12th mark sheet that you have, the CA foundation mark sheet that you have. Okay, now what do you think? Is it opinion in the eyes of the institution from ICI? Let's say ICI has given you CA foundation mark sheet, CA foundation pass certificate. Okay, is it an opinion or is it a certificate? Is there any doubt that you have not passed CA foundation? Let's say they have given you 60 marks in accountancy. Is there any doubt that they think that, okay, in our opinion, he has got 60, or they say it firmly that yes, he has got 60 in accounting, and they sign it. Okay, so when I say certificate, please understand there is no doubt about it. If you have received a certificate from ICI, a pass certificate from ICI regarding, let's say, CA foundation, there is no doubt about it. There is no second thought about it that you have not passed. Okay, but when I give an opinion, there can be two views on it. There can be, if somebody else comes, he can give altogether a different opinion. Okay, so this is a difference. Okay, again, let me give some more examples so that you understand the difference between the word opinion and the certificate. Okay, now let's say two friends. Okay, they plan for a movie. They plan for, let's say today is 7th September. They plan for a movie, a night show. Okay, now both of them go and watch the movie. One friend, let's say there are two friends, A and B. Okay, one friend is of the opinion that the movie was superb, amazing. One says it was an amazing movie. He gives 5 stars. Second one says he did not like the movie at all. It was so slow. There was no fun. There was no comedy in the movie. No good songs. All this he keeps on saying, and he gives a 2+ rating, 2-star rating. Can this happen or not? This is opinion. This is opinion. Okay, the friends, they have just given opinion. Okay, is the opinion given by A and B different here? Yes. So what is opinion? Opinion is one's point of view. It can be different. Okay, but let's say before the movie starts, you get a certificate also from the Central Board of Movies and all. So whether it is a universal UA movie or whether it is an adult movie, whatever it is, you get a certificate. Now this is a certificate. Can the department issuing this certificate, the Central Board of the censor board and all, which the ones who issue this certificate, can they have two opinions about it? Can anyone say, I think no, this is a movie which can be watched by all? No, this is I think it is an adult movie to be watched by 18+. There cannot be two views about it. If they issue a certificate that yes, this is an adult movie, it is an adult movie. If they issue a certificate that yes, it can be watched by all, that means it can be watched by all. There is no second thought about it. So please understand the difference between opinion and certificate. When I say that when I talk about opinion, this means there cannot be any second thought about it. Okay, so whatever is written in the certificate is a fact. It is an established fact which cannot be challenged. Okay, but opinion is just one's point of view. Okay, now again let us understand the significance of the word opinion again. In auditing, coming back to the auditing definition, in auditing the auditor only issues opinion. He gives opinion on after examining the financial information. Okay, so let me read the line again, definition again. Audit is independent examination of financial information of any entity, whether profit oriented or not, and irrespective of its size or legal form, when such an examination is conducted with a view to expressing an opinion thereon. Okay, so the auditor only gives an opinion thereon. Alright, he cannot issue a certificate. Why he cannot issue a certificate after auditing? We'll come to this later on, because there are certain limitations of auditing. Okay, he cannot 100% say that yes, the financial statements are totally correct. He cannot give a certificate in this case. He only opines, he only gives his opinion here. Okay, and I've told you this, that one financial statement, if it is, let's say, checked by 2 chartered accountants, 2 auditors, they might have different opinions also. Okay, so please understand the word significance of the word auditing. Okay, significance of the word opinion. Now again, let's say yes, okay, again let's take the example of 2 friends here. Okay, we are again discussing the significance of word opinion. This is really important word. You need to understand why are we using the word opinion again and again in auditing. Okay, now let's say 2 friends, A and B. Okay, now A basically A wants to shop something. Okay, he wants to buy some clothes. Okay, the next day he has to, let's say, go out on a date with a girl. Okay, so he wants to buy some good clothes. Okay, he takes B along for shopping. Okay, he believes that okay, B has got a good taste and all, so B will help A to do the shopping. Okay, to buy clothes. Okay, now what happens is okay, so they go to, let's say, Shopper Stop. Okay, they go to Shopper Stop, and A basically selects few clothes, few shirts and few trousers, let's say jeans. Okay, and B also helps him. Okay, so A selected, let's say, one white shirt, but B comes and tells, oh no, this is not looking good at all. You will not look, this is not going to look good or great on a date. Okay, so B helps him, and B basically comes up with some very loud colored shirts and all, some flashy neon orange shirt, green shirt and all. A, somehow he feels that these colors are very loud, but he, okay, because B insists, okay, these are in fashion, you buy it, just buy it, trust me on this, she will like it, all this B says, okay, and somehow A buys them, okay. Now next day A goes on the date, okay. Goes on the date and wearing the, let's say, bright orange, fluorescent orange shirt, okay. And the moment he meets the girl, okay, the first thing that the girl says is, what the hell are you wearing? What the hell are you wearing? Is this what you wear on a date? Is this what you wear on a date? And she gets angry and probably she just wants to go away now, okay. A gets really very angry. A really is now super hyper. He immediately calls B and he starts yelling on B that because of you, she's now angry. She's not talking to me. What shirt you made me buy yesterday? All this A keeps on saying to B. Okay, but now can you please tell me? He is so angry. A is so angry. He even tells that I'll sue you in the court. Okay. Now will A be able to sue B? Now, will A be able to take B in the court of law? Obviously, the answer is going to be no. A will not be able to sue B, because what will B say? B will say that I just gave you my opinion. I just gave you my opinion that this shirt might look good. If you were not very sure, why did you wear it? B will just escape from this entire scene by saying that I just gave you my opinion. Okay. Had it been a certificate, try and understand. Let's say B issues a certificate. Had it been a certificate, A would have been able to take B in the court of law. Not for this matter, obviously, but yes. By this example, I was just trying to explain you the difference between opinion and certificate. Certificate means there is no second thought about whatever is written in it. Whatever is written, mentioned in the certificate is 100% correct. Whatever things are written, it is an established fact, let's say, okay. But opinion, it can be different. It can be two chartered accountants, if they are auditing the same financial statements, can end up with different opinions also, okay. So understand this, that opinion is one's point of view, and obviously it cannot be challenged, okay. Now, why does a chartered accountant give opinion? We'll discuss this later, because there are some limitations in audit because of which he cannot issue a certificate. Had he issued a certificate, he would have basically communicated through the certificate to the users that beyond doubt the financials are correct. The financials of the entity are correct. But this is not the case in case of opinion. In opinion, when auditor issues opinion, the language which he uses, that in his opinion, the financials are correct. Okay, the opinion might change. All right. So please understand that again, in case of auditing, the word opinion is used. Now, I have discussed the significance of the word opinion, but now let me discuss what kind of opinion is given by the auditor. Okay, I have been telling you that he checks the financial statements and he gives an opinion. He checks the financial statements and he gives an opinion. I have been telling you that in layman's terms, that let's say he is going to give an opinion that the financial statements are correct, but this is not the actual opinion which an auditor gives. Now let us understand. When an auditor examines the financial statements, that means when an auditor is auditing the financial statements, what kind of opinion he can give. Okay, so the point here is opinion. Okay, let us understand the word opinion. It says opinion means one's point of view towards any given fact. One's point of view. Okay, and certificate means, on the other hand, means establishing a given fact. Okay. Now, auditor usually issues opinion and not certifies the financial health of an organization. You have to understand this, that while auditing, auditor only gives opinion. Okay. Now, what kind of opinion is given? This is mentioned here. The opinion that he is called upon to express. The opinion that the auditor is called upon to express is whether the financial statements reflects or are giving a true and fair view. So we have another word to understand here. What kind of opinion does the auditor give in auditing? While auditing, he gives an opinion whether the financial statements are giving true and fair view. You have to understand this word also. So true and fair view also we are going to understand. If you can see, we have the term true and fair view. also. Okay, so again, let's go by the sequence again. Okay, there are financial statements prepared by the management, then there are certain users of the financial statement. Now these users, they'll not place reliance on the financial statements, hence audit is done. Okay, and the financial statements management is not going to prepare it randomly. They are going to use FRF, financial reporting framework, to prepare the financial statements. Now auditor will come, he's going to audit the financial statements, and once he is done with auditing, he is going to give an opinion on the financial statements. What kind of opinion he is going to give? He is going to give an opinion whether the financial statements are giving true and fair view or not. Okay, he is never going to say that the financial statements are correct, the financial statements are okay, the financial statements are good. Okay, we generally as an auditor, we use the term that the financial statements are giving true and fair view. Now what do you mean by true and fair? Let us discuss this term. Okay, so we have another term, true and fair. Alright, now all these terms, again let me tell you, these terms are very basic, very fundamental, okay, and these are really very important. Okay, so be very clear on these concepts, these terms, and these terms, because it will be used in the upcoming chapters, it is very vital for you to understand. Okay, now what is true and fair view? Now again, I told you that the auditor is going to give an opinion that the financial statements are giving true and fair view. So let us understand the words here. There are two words again, true and fair. Okay, now let me discuss true and fair with the help of an example. Okay, now let's say there's this company, and they bought plant and machinery, let's say worth rupees 10 lakhs. They bought plant and machinery worth rupees 10 lakhs. Okay, there's an entity XYZ Private Limited. Okay, now they bought it on 5th September, let's say. Okay, now once, let's say they have bought plant and machinery worth rupees 10 lakhs. Okay, now they have correctly recorded the figure as 10 lakhs in their books. Okay, obviously this they'll record the asset in their books. Okay, but they have correctly recorded the figure of 10 lakhs in the books. That means they have truthfully recorded the transaction. They have truthfully recorded the transaction. Please try and understand. Okay, what I'm saying, they purchased plant and machinery worth rupees 10 lakhs on 5th September, and they have correctly recorded the figure of 10 lakhs in their books. Okay, but instead of capitalizing, they have basically made an entry of, let's say, in the PL. They have made this entry in the PL. Now the figure 10 lakhs is correct, but do you think is it fair? Is it fair to, let's say we have bought plant and machinery, instead of capitalizing it, they have put it into revenue, they have debited into PL. Is this correct? Yes or no? Are you all with me? It is not correct, right? The figure, no doubt, the figure of 10 lakhs is correct. That means they have truthfully recorded the item of 10 lakhs in the financial statements, but they have not presented it fairly. The item should have been capitalized, but they have shown it as revenue expenses. Okay, so what is true and fair? Try and understand. True means something which is correctly recorded, which is truthfully recorded in the financial statements, but fair means it has to be presented fairly also. How can you show something of capital nature as revenue expense? Okay, so true and fair is the term used in the audit report to express the condition that the financial statements are truly prepared and fairly presented. Okay, now what does true mean? True suggests that the financial statements are factually correct. They are correct. Okay, and fair implies that the financial statements present the information faithfully. That the information presented is correct, is done faithfully. So when I say true, please understand, true means that the figures and all have been correctly recorded. They are correctly recorded. Okay, factually correct. When I say fair, fair basically is with respect to presentation. You cannot show an item of capital nature in the PL account. Okay, true means what? That the figure has been correctly recorded. Okay, so it says, again I'm reading. True suggests that the financial statements are factually correct and have been prepared according to FRF, and fair implies that the financial statement present information faithfully without any element of biasness. They have to be presented faithfully. Okay, so fair is basically more related with presentation, and true is more related with correct recording of transactions. Okay, all right. Now, okay, again let us understand the sequence. I have done the auditing. of the financial statements. Now I'm going to basically give an opinion. Okay, what kind of opinion I'm going to give? If I'm going to give an opinion that the financial statements are giving true and fair view, where do I need to give the opinion? Will I tell the management or verbally that your financial statements are giving true and fair view? No, the answer is no. I need to basically jot down my opinion in a document which we call it as audit report. Okay, so as an auditor, when I'm done with the auditing, I'm going to issue an audit report wherein I'll be mentioning my opinion. Okay, so this opinion, if you can see, the next term is audit report. It is nothing but a report in which auditor expresses his opinion on the financial statement. We are not going to give a verbal opinion here. Please understand, auditor is always going to give a written opinion, and the place where he writes his opinion is known as audit report. The document in which he gives his opinion is known as audit report. Please remember that we as auditor, we are not going to give verbal opinion. So very easy point. What is audit report? Audit report is a document where the auditor gives his opinion. Okay, he expresses his opinion. Okay, what kind of opinion? He gives whether the financials are giving true and fair view or not. Okay, now again, coming to this point again, true and fair view. One more important line that we have to cover here is financial statements will give true and fair view. When is the financial statement going to give true and fair view? We have one more important term to understand here. Financial statements will give true and fair view if they are free from material misstatements. Again, there is one more technical word which you have to understand. This line says that the financial statements will only give true and fair view when they are free from material misstatements. Again, two words you have to understand. First is misstatement, and the second word which we are going to understand is material. Okay, now again, I told you this auditor is going to give opinion. What opinion? That whether the financials are giving true and fair view or not. Where is he going to give his opinion? In an audit report, sir. Okay, how will he know that the financial statements are giving true and fair view or not? So he needs to check whether the financial statements are free from material misstatement. Okay, so financial statements will give true and fair view only if they are free from material misstatements. Now, what is material misstatement? Let us understand these two words. Okay, so if you can see, the next two words are material and misstatement. So first we are going to understand the word misstatement. What do you mean by misstatement? A very simple definition, let us understand. Okay, so it says when an item or information is wrongly stated in the financial statements. When any item or information, let's say it is wrongly stated in the financial statements, it is referred to as misstatement. Okay, any item in the financial statement, it is wrongly stated, it will be termed as misstatement. Okay, a mistake, basically a mistake. Okay, all right. Now yes, technically misstatements includes, now this was a layman's definition, that anything which is wrongly stated in the financial statement is referred to as misstatement. Now please answer this question to me. The company bought plant and machinery worth 10 lakh rupees. Okay, but they have, when they were posting entries, they skipped 1 0. They omitted 1 0 and they made entry of 1 lakh. Is this a misstatement or not? Yes. So it says when an item or information is wrongly stated in financial statement, it is referred to as misstatement. So this is a misstatement, right? But this is just a layman's definition of misstatement. Let us get into a bit more technical definition. Technically, if I say misstatement includes any difference between what is required by applicable FRF. What is required by applicable FRF? Now I just discussed the word FRF with you. FRF stands for Financial Reporting Framework. Okay, and we discussed some of the examples also of Financial Reporting Framework. I told you that Schedule 3, Ind AS, US GAAP, IFRS, all these are examples of FRF. Okay, so what is misstatement? Misstatement includes any difference between what is required by applicable FRF and what is included in or omitted from the financial statements. Now for example, please understand this. Okay, I just told you that instead of writing 10 lakhs, they have written 1 lakh. This is a misstatement, no doubt. This is a misstatement. I am writing it as MS. Okay. Now, let us say the company has certain inventory. The entity has certain inventory. Okay. And they have valued their inventory on the basis of LIFO method. And because of this valuation, as per LIFO, their let's say their closing stock is overvalued, let's say by 2 lakhs, and because of which the profits are overstated by 2 lakhs. Now I am asking, my question to all of you is, the management of the organization has valued inventory using LIFO method. Will it amount to misstatement? Yes, Sai Lakshmi saying yes. I want to see, when I started with the session, I thought we'll make it very interactive, but you all are not responding. That is why the number of questions which I should be asking is also going down. Let us not make this happen. Let us fully utilize this live class and let's be responsive. Okay, please interact so that I ask you questions and you answer, and things will happen. The more you answer, trust me on this, the more you'll be able to remember the concepts. Okay, so now my question to all of you is, they have valued inventory using LIFO method. Okay, now why do you think Sai Lakshmi just told that yes, this is a case of misstatement? Why do you think this will amount to misstatement? Yes. AS, which AS? Inventory is AS. AS2. Okay, so AS2 says AS2 plus first thing, is AS2 a FRF or not for us? Is AS2 an FRF? Yes. Okay, so that AS2, that AS2 says that inventory can be valued only on the basis of FIFO and let's say weighted average method. Okay, weighted average. But this company, the entity under audit, they have valued inventory under using LIFO method. So this would amount to misstatement. Why? Let's read the definition again. Misstatement includes any difference between what is required by applicable FRF. AS2 says that we have to value our inventory as per FIFO or weighted average, but we have followed LIFO, so this would amount to misstatement. Okay, and so any difference between what is required by FRF and what is included or omitted from the financial statement. So we have included inventory, but we have valued it differently. Okay, now let us say we have certain related party transactions. Do you understand what related party transactions are? Yes. Okay, you must have heard about it. Okay, now there are certain related party transactions. Okay, no problem about it. But all the transactions with related parties, they have been correctly recorded in the financial statements, no doubt about it. But as per AS 18, we have to disclose the related party transactions in our notes. Okay, if you know, we are going to mention the name of the related person. Okay, the type of transaction that we entered into with the related person during the current year, the outstanding balance as at the end of previous year, outstanding balance as at the end of current year. This is a format basically that is required by AS 18 to be mentioned in the notes of accounts. Now please understand, the management of the company, they mentioned all the related party transactions correctly in the financial statements, but they forgot to basically make a note of related party transactions, which is required by AS 18. Okay, now will this amount to misstatement or not? Will this amount to misstatement? Yes. So please understand, something which is required by FRF, if you omit it also, this will also amount to what? Misstatement. Okay, so see, right from, let us understand few more examples of misstatement. Okay, I told you this, that rather than entering 10 lakh rupees, I have entered 1 lakh rupees. Okay, so this is also a misstatement. Let's say I altogether forget to enter the plant and machinery which I have purchased. Is it a misstatement or not? I have not made any entries in the books with respect to the plant and machinery which I have just purchased. So it is also a case of misstatement. Okay, I have mentioned we have inventory coming in our balance sheet. I have duly shown the inventory. Okay, but I have wrongly valued it. I have valued it using LIFO method. Again, it is against AS2. So this will amount to misstatement. Okay, related party transactions. Okay, whatever, let's say sales purchases was there, I have duly recorded all the sales and purchases in my PL account. Okay, in my trading account, in my PL account. But as per AS 18, I was supposed to make a note of, I was supposed to make a basically schedule of all the related party transactions, but I have not made it. So again, this would amount to misstatement. Is this clear? Alright, now yes, So misstatement, again let me read the definition. Technically, misstatement includes any difference between what is required by applicable FRF and what is included in or omitted from the financial statements. Okay, so now let's say a company is they are basically they are required to, let's say, calculate depreciation on the basis of useful life method. Okay, but this company under audit, they have totally used another method of depreciation which is not required, which is not mentioned in FRF. So again this would amount to what? Misstatement. Okay, so technically, again reading the definition, misstatement includes any difference between what is required by applicable FRF and what is included in or omitted from the financial statements. Okay, now misstatements can arise either from fraud or error. Now, two reasons because of which misstatements in an organization's financial statement can happen is either because of fraud or it can be because of error. Okay, so misstatements can be because of fraud or it can be because of error also. Alright, now let us understand the two terms. You all know when something is done intentionally in the financial statements, let's say they have inflated the sales just to show that they are doing good. Okay, they have inflated the expenses in order, they have inflated the expenses so that their profits go down and ultimately the tax liability goes down. Now they have done this intentionally. So when misstatements are done in the financial statements intentionally, okay, we call it as fraud. Okay, and obviously sometimes misstatements can happen due to carelessness, due to errors also. So when misstatements occur because of errors basically it is unintentional. This is unintentional. Okay, so let us read these two words, that misstatements occur because of fraud and error. Okay, again misstatements may arise because of fraud or error. So intentionally misstating the financial statements, word is, just remember one word, if the misstatement is done intentionally in the financial statements for whatever reasons, it is called as fraud. So intentionally misstating the financial statements for whatever reasons will be called as fraud, and error obviously is what? Unintentional misstatement, something which happens, let's say, out of carelessness, out of our lack of knowledge, let's say, of FRF, etc. Okay, so misstatements arise either from fraud or error. Okay, now what we were actually discussing, that the auditor is going to give an opinion on the financial statements. What is the opinion that is going to give? Whether the financials are giving true and fair view. Okay, now I told you this, when will the financials give true and fair view? When the financials are free from material misstatement. Please understand this. Okay, so when the financials are free from material misstatement, then only we say that the financials are giving true and fair view. But as of now, we have only discussed the word misstatement. Misstatement can be any error, can be any mistake in the financial statements, but now we need to understand the word material also, so that we can understand the two words together, what amounts to material misstatement. Okay, so coming back to the topic of misstatement, let us understand. Material is given here on page 2. Okay, so what is material? Okay, it says that, see, misstatements in financial statement has started the definition with misstatements only. Misstatements in financial statements are material when they can reasonably be expected to influence the decisions taken based on those financial statements. Now, if I say material, if I go by the layman's language, material means something which is of significance, something which is really very important. Okay, something which is very important for the organization. Okay, it is so important that if this particular item is misstated, it may influence the decisions which the users make from the financial statement. Okay, now I'll give you examples, don't worry about it, but let us understand the word first. Material means something which is really very important, okay, which is of high significance. Okay, and if this item is misstated, okay, the users will end up taking wrong decisions. The users' decisions would change. If item is of such significance, we call it as material. If the item is of such significance, we call it as material. Okay, now again let me read the definition. Misstatements in financial statements are material when they can reasonably be expected to influence the decisions taken based on the financial statement. When it will basically influence the decisions that the users make for the financial statements. Now let me give you an example. Okay, now let's say, let me talk about the profits of the organization. Let me talk about the revenue or the profits. Okay, now let's say this profit, okay, let's say it has been misstated. That means something is wrong in the profits. Okay, now because of this misstatement in the profits, okay, let's say the profit because of the misstatement, actual profit, let's say, is 2 lakhs. Okay, now because of the misstatement, because of some errors in the financials, okay, the profits come down to minus 50,000. Now don't you think that let's say I am a prospective investor, I wanted to invest in this company, but now I see the financials, I see, oh, the company is not doing well, it is already in loss, let me not invest in the company. My decision altogether is going to change or not? Yes. So profit, if it is misstated, it is a material misstatement. Material, why? Because of misstatement in this aspect, the decision of the user changed. It influenced the decision of the user. Earlier I was planning, had the profits been of, let's say, 2 lakhs, I would have purchased the share, but now because profits have been misstated and it has been shown as 50,000 loss, probably I will not be buying shares of the company. So this is material misstatement. Okay, so again let me read the definition. Misstatements in financial statements are material when they can reasonably be expected to influence the decisions. They are going to influence the decisions taken based on those financial statements. Okay, now a very important point again to understand here is the next point. Misstatements can be material either by magnitude or due to the nature of the item. Now misstatements, something we are going to call something as material not only by because of its magnitude, but it can also be material because of the nature. Now please understand this. Okay, let's say we have a company here and the total assets of the company is 10 lakhs. The total assets of the company is 10 lakhs. Okay, the company has inventory worth rupees 8 lakhs. The company has inventory worth rupees 8 lakhs. Okay, now please understand this. Don't you think that this inventory item is material now? Is it material or not? Is it of high significance? Yeah, what is the reason? Because this inventory constitutes what? 80% of the total assets. So this is something which is really very significant here. So what I'm trying to say is material can be because of magnitude. No doubt the magnitude here is very high. Okay, it constitutes 80% of the assets. Okay, so if there is a misstatement in this particular item of inventory, obviously it will be a material misstatement. It will basically influence the decision of the users. Alright. Okay, but let's say that let's say the inventory amount is only of rupees 80 and the total assets is 10 lakhs. Total assets is 10 lakhs, inventory amount is only rupees 80. Now what will happen? Even if there are misstatements in this 80 rupees, even if it should have been, let's say, 82, or if it has not been properly valued, whatever it is not going to influence the decisions of the users, because the magnitude is very less, extremely low. It is not going to impact the decision making of the users. Okay, because out of total assets, it is not even, let's say, 1% of the total assets, so it cannot be termed as material. Are you able to understand? So materiality, please understand, it can either be by magnitude. So the examples which I just gave you, both the examples are with respect to the magnitude of the item to be termed as material. Okay, now let me take one more example. It says misstatements can be material either by magnitude or due to the nature of the item, Now let's say the company, there is a company. Okay, the company has given loan. The company has given loan to the director. Okay, who puts in the money in the company? The shareholders. Okay, shareholders have put in their money in the company. It is the shareholders fund in the company. But the company, because it is managed by the directors, what did the director do? He took loan from the company. He took a personal loan from the company amounting to, let's say the total valuation of the company is 10 lakhs. Okay, shareholders funds was, let's say 8 lakh rupees, whatever it is, 8 lakh total. Share capital was 8 lakh. Okay, shareholders fund was 8 lakh rupees. The director took a loan of, let's say, even 2,000 rupees or 20,000 rupees. Now this amount to 20,000 may not be material. Let's say if you consider 10 lakhs as total assets, this amount may not be material, but the nature of item is such that the shareholder should know that the money which they had invested in the company, the director has taken some portion of that money for his personal use. The director has taken loan out of that money. So even though the amount is not very high, the nature of the transaction is such that the shareholder should be knowing about this. Okay, so please understand, materiality can be because of magnitude obviously, but also because of the nature of item. Now if the financials do not disclose the fact that 20,000 has been given to as loan to directors, this would amount as material misstatement. Okay, so again let me repeat, what is materiality? What is material? Okay, when do we say a misstatement is material? A misstatement will be termed as material when it basically influences the decision. It might influence the decision of the users. Okay, now this is an item. See, the loan to directors. The company gave loan to directors. No doubt the amount is very less. 20,000 is a very small amount. But the nature of the transaction is such that all the shareholders should be knowing about this, because it is their money and the director is using for its personal purpose. Okay, so they should be knowing about this. So in case the financials do not disclose this fact that 20,000 has been given to the directors of the company, it will amount to misstatement. Is it clear or not? Yes, everyone? Okay. All right. Now, see, don't you think, why did I tell you this? Again, I have written a lot of things here. Okay. Okay, I have some space here. Let me come back to this point. Now, auditor gives an opinion on the financial statements. What opinion does he give? That the financials are giving true and fair view or not. When will the financials give true and fair view? Only when the financial statements are free from material misstatement. When the financial statements are free from material misstatements. Please understand this. The auditor is going to give an opinion that the financial statements are giving true and fair view only when the financial statements are free from material misstatements. This simply implies that the auditor will not be concerned with each and every misstatement in the financial statements. He is only going to be concerned with misstatements which are material in nature. He will not be bothered if the debtors have been undervalued by 1 rupee or 2 rupee. That is not going to impact the decisions of the users. Okay, and it is not possible for the auditor to check all the misstatements. There may be some misstatements which are very trivial in nature, which will not impact the decisions of the users. So the auditor will not be concerned with those misstatements. Okay, auditor will always be concerned with material misstatements. Okay, so this concept I have just written in one line here. No doubt we are going to discuss this at length when we start with chapters, but yes, check this point here. Since it is not practical for the auditors to detect all misstatements, it will not be possible for the auditor to check all the things in the financial statements. Now imagine, let's understand let's take the case of Airtel. Okay, now Airtel, you all know, let's say I am auditing not the entire Airtel. Let us basically take the case of, let's say, Airtel Northeast. Okay, now I am an auditor of Airtel's Northeast Circle, Northeast Zone. Okay, I have been asked to audit the financials for the Northeast area of Airtel. Let's say I am not taking the case of entire India. Let us take the case of only Northeast. Okay, now imagine. Okay, I tell them, okay, I have come to your place for audit. Okay, they say, very good sir, welcome sir. Okay, then what I ask them, I tell them, how many subscribers do you have in Northeast? Okay, so they tell me that, sir, we have roughly around 15 lakh subscribers. Let's say they have 15 lakh subscribers. Okay, I tell them, okay, very good. And I tell them, okay, if you have 15 lakh subscribers, okay, that means let's say some must be of prepaid, some must be prepaid customers, some may be postpaid customers, okay, some may be, let's say, using your internet connection, other services, okay. So they tell me that they have 15 lakh subscribers in a month, okay. So now understand this. So 15 lakh subscribers they have generally, and all these subscribers do a monthly recharge or monthly payment of bills, whatever it is. So I tell them, okay, give me the documents. I am going to check the 15 lakh subscribers invoices, whatever you have issued, that vouchers I am going to check, okay. Now imagine 15 lakh vouchers, 15 lakh documents or invoices, whatever I have issued, let's say 15 lakh vouchers I am going to check. This is only for 1 month. Let me multiply it by 12. This is going to come to some 1 crore 80 lakh vouchers, something, let's say something like this. Now in the given time frame, generally when will I be auditing? Okay, let's say for the financial year 19 20, okay, when will I be auditing? Obviously when the financial year ends, let's say when the financial year ends in the month of, let's say, April, in the month of April 2020, I'll start the auditing, okay. And imagine if I start checking all the vouchers here, all the documents here, I will probably not be able to finish auditor in 5 to 7 years time, okay. And you all know okay, what is the time limit in case of a company? Let's say this is a company, we are assuming it to be a company, okay. In case of companies, okay, when is the AGM supposed to be held? In case of companies, when is the AGM supposed to be held? Within 6 months from when, Aditi? Let's say within 6 months from the end of the financial year, okay. So for this financial year, when is the AGM supposed to happen? Can I say 30th September 2020? This is the last date on which the AGM should be done. And what can you name 4 businesses that are to be done in discussed in AGM? What are the 4 agendas that are discussed in the AGM? Okay, Ramji, yes. What is the first business? Adoption of financial statements. Okay, adoption of accounts. Okay, then declaration of dividend. Great. Okay, then okay, appointment of auditors, and one more point, of directors. Exactly, of directors. Okay, so please understand this, that yes, please. So see, no, see, if there is any problem in the app, if you are not able to see, just quickly come out of the class and again rejoin the class. Things will be okay. Okay, that means problem is there. All of you, is it blurred for everyone? Okay, just let me check. Okay. So now are you able to see, or is it still blurred? Visible? Fine. Okay, all right. So If it happens again, please kindly let me know. Okay, all right. So in AGM, 4 businesses are discussed. You have told it correctly. Now my point to you, all of you, is now if the AGM, on the date of AGM, obviously adoption of accounts, adoption of financial statements is done. Okay, now adoption of financial statements is done. This means what? That the financial statements have to be audited in time, and for an AGM to happen on 30th 9 2020, how many clear days do we need to send notice for the AGM? 21. So let's assume, 21 clear days. So let's assume that, let me tell you that, let's say the notice for the AGM must be sent by, let's say, 1st September. Even though we have more days, but let's say 1st September. Now what I'm trying to tell you is that we have to complete audit April, May, June, July, August, September. From April we have 6 months to, let's say, complete the audit. Okay, but if I am an auditor, I would not be just auditing Airtel. I have other clients also. I cannot devote 6 months only to the work of audit. Only to the auditing the work of Airtel. I cannot devote 6 months here to one company. Okay, and in this 6 months, let's say even if I am I am only auditing Airtel, they are paying me good fees, I am only doing their audit, and even in this 6 months, let's say, will you be able to check 1 crore 80 lakhs voucher? Will you be able to check 1 crore 80 lakhs documents? It is not possible. Even if I have a good team, it is not possible. So what I am trying to say, it is not possible for the auditor to detect all misstatements in the financial statement, and he is not even concerned about detecting all misstatements in the financial statement. But what he is concerned about is he needs to ensure that all material misstatements in the financial statements are corrected. All material misstatements in the financial statements are corrected. So probably you know what he is going to do. Now the management told that there are, let's say, 15 lakh vouchers, 15 lakh subscribers. What he is going to do, he is not going to check all the 15 lakh subscribers. He is going to tell the management, okay, pull out all those vouchers, give me all those vouchers, the monthly billing of which is more than 3 lakhs. The prepaid customers say, sir, they only do recharge of 300 rupees. I tell them, no, I am not bothered. You give me all the vouchers which has a monthly billing of 3 lakhs. So basically, I will be checking more on the corporate billings and all, wherein the monthly billing is more than 3 lakhs. So I have set a limit. Anything above 3 lakhs, I am going to check. Anything below 3 lakhs, I am not going to check, because the auditor feels that anything below 3 lakhs may not be material. Okay. So what I am trying to tell you is, auditor can never check 100% of the transactions, okay, because they are especially in this case, because the volume of transaction is huge, okay, and because he cannot check each and everything, I can say it in this way, that he will not be checking all the misstatements. Auditor will not be concerned with all misstatements, but he will only be concerned with those misstatements which are material in nature, okay. And I told you this, that can material be because of magnitude also, and can material be because of nature also? Something can be termed as material because of its magnitude and because of its nature also. Now let me take an analogy, let me discuss an analogy so that you understand this perspective better. Okay, now let's say you clear CA inter exams and you go for articleship. Okay, so let's say you join an office, and the office time is basically 10 a.m. Okay, probably what happens, during the first few days of your articleship, your office starts no doubt at 10, but you will be very punctual. You will reach by 9:45, 9:50 and be there in the office. Okay, so this is generally how it starts. But as and when you become familiar with the organization and all, probably 10 a.m. will after some days become 10:05. Okay, some days because of traffic you may reach at 10:10, and some days it may go up to 10:15 a.m. also. Okay, but now what happens, let's say if you start coming at 10:05, 10:10, 10:15, probably you will not get a scolding from your principal, from your boss. Okay, but let's say someday, on one fine day, you reach office at 10:55 a.m. 10:55 a.m. Probably you are going to get a scolding from your boss here, because now what has happened, the magnitude of the delay has increased and it has become a material delay. So you will get a scolding from your boss. So materiality is here in case of magnitude, because of magnitude. Okay, but let's take one more example. Okay, today is, let's say, 30th September. Today is 30th September, and it is the last date of last day for filing income tax returns, and we are still left with filing 10 returns. Okay, today is the last day. Now in this scenario, on this date being the last day of filing your returns, even if you reach office on 10:05 or maybe 10:10, though the delay is not material, though you were not getting scoldings on regular days because of a delay in 10 minutes, because of a delay by 10 minutes, but on this date, even if you are delayed, if you get late by 10 minutes, probably you might get a scolding from your principal, probably you might get a scolding from your boss. Okay, why? Because the nature of the delay is significant here. On 30th September, the delay of 10 minutes is also not tolerable. Okay, so what I'm trying to make you understand here is that materiality is not always by the magnitude of the amount, let's say, is not determined only by the amount. It can be also material. Some transaction may be also material because of the nature of the transaction. Now for example, I told you loan to directors. This is something, let's say the amount of loan is not very high, but this is a transaction which the shareholder should be knowing, because it is the money of the shareholders and director is using, let's say, for his personal purpose. So even though the amount is very trivial, but the shareholder should be knowing about it, hence that will be termed as material. Okay, so again, I am reading one point here in the definition of material. It says, since it is not practical for the auditors to detect all misstatements. I told you it is not practical for the auditor to check all the 1,80,000 vouchers in the given span of time. It is not possible for the auditors to do extensive checking. Okay, so it is not practical for the auditors to detect all misstatements. They focus their work on detecting material misstatements only. So the focus will be on only detecting material misstatements. Is this clear to you or not? Yes or no? Yes sir. Okay, all right. Now can I now say it in this way, that if the financials are free from material misstatements, if the financials of an organization prepared by the management are free from material misstatements, can I say that the financials are giving true and fair view? Can the auditor give an opinion, okay, that the financials are giving true and fair view? Yes. And where is he going to give the opinion? I told you this, that he is never going to issue a verbal opinion. Obviously, he is going to express his opinion in the audit report, in a document which we call it as audit report. Fine. Okay. Now, we have covered a good number of terms today. Just one more term I need to discuss with you is last term, internal controls. For this session, last term that we need to discuss is internal controls. Okay. Now, what is internal control? I am very sure you must have come across this word in EIS also. You understand now what controls means. Okay. So internal control, let us read the definition. I'll give you some examples here, and we are going to discuss the relevance of internal controls with respect to auditing now. Okay. Now, what is internal control? It says internal control is a process put in place by the management. Please remember, any controls in the organization, it is put in by the management. The controls are the responsibility, the design, the implementation and the maintenance. Three words you have to understand: design, implementation and the maintenance of internal controls is the responsibility of management. Okay, why do they put in internal controls? Why do they place internal controls in the organization? To prevent, detect and timely correct material misstatements. Okay, so they are having internal controls here to prevent, detect and timely correct material misstatements. Material misstatements we have just covered, and you all know that misstatements arise either due to fraud or error. Okay, so what is internal controls? Internal controls are processes, they are policies put in place by the management of the company. Okay, so that the chances of misstatements in the financial statements get to an acceptably low level. They are able to prevent, detect and correct the misstatements which happen due to fraud or error. Okay, so this is just a definition. Now let us understand internal controls practically. Okay, now yes, let us discuss internal controls. Okay, now let's say yes, we have let's say we have a purchase department in our organization. Okay, Now what happens, we are going to discuss a process and we are going to understand the control. Okay, now we have a purchase department in the organization. Okay, this purchase department, whenever they place order to a vendor or a supplier, please understand this. Okay, whenever they place an order to this vendor or supplier, they cannot randomly just call and place an order. Okay, so the purchase department, they will probably, before giving order to this vendor or supplier, they should basically have some controls in place. They should basically, if you understand the purchase process, okay, they need to basically invite tenders. Okay, they are going to basically float some tenders. Okay, and then many vendors are going to respond to the tenders. Now they are going to choose the best vendor. They are going to select the vendor. Okay, and when they select a particular vendor out of so many tenders, obviously the vendors are going to give their quotation. On the basis of best quotation, they are going to select their vendors. Okay, and when they select the vendors, let's say he is the selected vendor out here, so purchase department is going to give them their orders in a document which we call it as what? Purchase order. Okay, and now please understand, on the basis of this purchase order, the vendor is going to supply the material. Okay, the material is going to come now. The material will be received by whom? The material will be received by the stores department. The whatever material we have purchased, it will be received by our stores department. Okay, so now please understand, when the material is received by the stores department, okay, the stores department will basically check whether all the materials that were ordered have been received or not, whether all the material that we had ordered, whether it is received or not. And whatever material is received, this store department will prepare a document which we call it as GRN. GRN stands for goods received note. Okay, so purchase department gave a purchase order, okay, to the vendor. Now when the vendor supplies the material to the stores department, the stores department is going to come up with a document which we call it as goods received note. Okay, just for an example, I am discussing this case. Now this vendor, at the same time, along with the material, he is going to issue an invoice also. Obviously, he is going to bill us, right? He is going to give us an invoice for whatever things we had purchased. Okay, so this invoice is going to go to which department? The accounting, let's say the finance department. Okay, and obviously, since the invoice has gone to the finance department, okay, the finance department is the one who is going to pay to the vendor. He is going to pay to the vendor. Okay, now merely please understand, if let's say there are no controls in the organization, the vendor randomly issues an invoice to the finance department and the finance department ends up paying for the bill, only to realize later that no purchase order was made for that particular goods and the material was actually not received at all. Okay, so if there are no controls in place in the organization, probably the organization might end up paying for those goods which were not ordered, or let's say those goods which were actually never received by the organization. So do you think upon receipt of the invoice, the finance department should immediately pay to the vendor? Upon receipt of the invoice, should the financial department immediately pay to the vendor? Yes or no? No. So how should they be paying? They should have certain controls in place. They should check the invoice. They should check obviously the invoice will have the quantity, the description of goods, right? So they are going to check the invoice. They are going to match the invoice with the purchase order. Whether the invoice contains all the items that we have purchased, whether the invoice contains all the elements that we had ordered. Okay, and obviously this document will also then be compared with goods received note, whether we have actually received what we had ordered, and whether the vendor has actually invoiced us for the things we had received. If there is a match between all the three things, then only the finance department should pay to the vendor department. Okay, now please understand, this we call it as three-way matching. Three things have been matched here. Okay, don't you think, yeah, this is a good control? Okay, had this control not been in place, Had this control not been in place, the finance department would have ended paying up for those invoices which were actually never ordered, the goods which we never received. And obviously this would amount to what? If this happens, this would amount to misstatements. We never purchased anything, but still we are paying for it. This is not, will this be a correct position of the financials? Will this reflect a correct position of the financials? No. So this would amount to misstatement. So what I'm trying to tell you all is, the organizations, they have various controls in place, various internal controls in place. The only purpose of having internal controls is that, internal controls, now I'm discussing from the perspective of accounting, okay. So the only purpose of having internal controls is that the financial statements are not misstated. There should not be any misstatements in financial statements, either due to fraud or error. Okay, now let us discuss, we can have n number of examples of internal controls. Let me discuss few more examples, few basic examples. Okay, now let's say yes, you all know this, that we have something called as let's say maker and checker process. You must have gone through this in EIS also. Now what is this maker checker system of control, maker checker process? Can anyone answer this? Maker checker process. See, we are just discussing about few random controls. Okay, maker checker process means if I have initiated a transaction, somebody else will check it. Somebody else will check it. This is an example of internal control. And when somebody else approves it, okay, or let's say somebody initiates the transactions, somebody else will approve it or authenticate the transaction. So this is also an internal control. If we have such controls in place, the chances of doing fraud in the systems, fraud in the accounts will be very less. So we need to have maker checker process. We need to have proper authentication processes in organization. Okay. So these are examples of internal controls. Now if I tell you practically, let me discuss few examples practically also. Okay. Now, let's say I go to a huge showroom. I go to Shoppers Stop. Okay, I go to Shoppers Stop, and if you have been to Shoppers Stop or any other stores of this kind, let's say a Central, or we have Lifestyle. Okay, now when I go, I need to, let's say, buy a jeans. Okay, I go to the counter. There is a Levi's counter and all. I buy a jeans. Okay, there are few employees out there who basically they assist us in making the purchase. They'll pick up the right jeans for us and all. Okay, so what I do is I pick up the jeans. Okay, I just have to buy one jeans. I pick up the jeans. Okay, now you just understand. I pick up the jeans and I immediately took out my wallet and I paid that employee. The employee told me, no, you don't have to make payment here. You have to go to the counter there to make the payment. Okay. Now I went to the counter and there was a huge line there. I told them, is there any other way of accepting the payments? They said no. I told, you have such a huge store with so many employees in place, so many employees at various brands. Why don't they accept the cash? Okay. So they told, sir, no, this is our policy that cash will only be accepted at the cash counter here. So I told them, why is the cash counter only here with 2 persons? Okay. So they gave me an answer. Sir, they explained me. They told, sir, if we authorize individual employees to take cash on behalf of every sale, okay, so what will happen? Let's say we close the store at 10 p.m. Each employee then, every employee, we have 200 employees working in our store. Every employee will have to come together. All the employees will come together. All the sales that they have made will now be deposited in the cash counter. The entire thing will be tallied, and then only when all the sales basically tallies with the cash received, then only the employees will be free. Okay. Now for example, some employees, let's say he has got 10,000 cash today, and somehow he misplaces a 2,000 rupee note and he is only able to give 8,000 in the counter. Now they will, entire night they will keep on reconciling, and this is not going to end only. And probably by the time it ends, again the next day, the 9 a.m., 9:30 a.m. we open the showroom only. So this is not going to happen. We close the showroom and we do the reconciliation process. This is not going to happen. So this is our control. If we have this control in place, the chances of misstatements, the chances that what amount of cash we have collected, it is not going to be basically misstated in the financials. So this is an internal control. Okay. All organizations in the world, any transaction they do are subject to some internal controls. Okay. You go to I give this examples in EIS also when we study control there. You go to you go to any shop, let's say a fast food counter, a fast food shop. Okay, now these days what happens, if you go to a fast food outlet, okay, you just sit and you order the food, but they'll first ask you to pay at the counter and take a token. Okay, then the token will have two parts. One is your receipt, and the other you have to give it to the counter, to the right counter. They'll see the counter, they'll see the token, and they'll basically prepare your food accordingly. So this is again an internal control. Even though your intention is, obviously you are a genuine person, you are not going to run away after eating the food, but still they have controls in place that you need to pay first. Basically a token coupon will be generated. You need to present the coupon at the counter, and then only they'll serve you the food. This is the system. This is their internal controls. Okay, so what I'm trying to tell you all is, by having the system of internal controls in place, the organization ensures that there is, let's say, no defalcation of cash. Okay, there is no pilferation of, let's say, food items or inventory. Okay, so all these things ultimately affect the financial statements. If there is defalcation of cash, obviously the financial statements will be affected. If there is pilferage of inventory, the financial statements will be affected. So that is why they have CCTV cameras. That is why I told you that they are never going to take authorize the employees to take cash. Okay, so we have controls everywhere. You must have seen that let's say when an ATM machine, when the bank or personnel, they come to refill the ATM machine with cash, you must have seen that they pull the shutter down, half shutter down, okay, and two persons basically go inside the ATM machine, the ATM counter, the ATM area, okay, and they refill the ATM machines. Now why are there always two persons? This is a dual control, dual authority. What if because of huge cash, one person's intention might change and he may run away with the cash? So we have controls, we have dual control here, okay. And in the food, in the fast food restaurant also, if you see always, the cash counter, there will be always two persons sitting there. In cash counters, you see that there will always be two persons. All right. So again, this is a dual control. All these examples are basically, which I have quoted, are examples of internal control. Okay. Everywhere, in case of banks also, if you do a transaction now these days, an OTP comes. Why? So that no unauthorized person can access your accounts, manipulate your accounts. So OTP comes. So all these are examples of internal control. Now please understand, the ultimate, why you have to understand 2-3 things regarding internal controls now. First thing which I am going to ask you is, who is responsible for internal controls? I want all of you to answer this. Who is responsible for internal controls? Who? The management. Okay, the management. Okay, so management is responsible for the implementation and the design and maintenance of internal controls in the organization. Okay, now please understand, as an auditor, please be very careful on this. As an auditor, what is our responsibility with respect to internal controls? Please understand this, that as an auditor, we basically try and understand this. We basically assess. We just assess how is the system of internal controls in the organization. We only assess the internal controls in the organization. Now, let's say on our assessment, we find that the internal controls are adequate. We find that the internal controls are adequate. Now, I want to ask you, if in an organization I find that they have adequate internal controls, now what will happen? What will be the chances? What will be the chances of material misstatement in the organization? Will it be high or will it be low now? If the internal controls in the organization are adequate, obviously, if the controls are good, the chances of them making mistakes in the financial statements will be high or low? Everyone. It is going to be low. It is going to be low. Okay, so the chances of misstatement is going to be low. On the other hand, let's say if I as an auditor assess that the internal controls are not adequate, the internal controls are, let's say, ineffective, they are not adequate. I just write word not adequate. Obviously, what is going to happen? The chances of material misstatement will be high. All right. Okay. Now let me discuss something with you, not in technical terms, but very generic things. Okay. Now, if you think that if you assess that the internal controls are not adequate, okay, and because of which you have determined that the chances of material misstatement is high, the chances of material misstatement is high. This simply implies what? This simply implies that the financial statements which we are about to audit, will it have more misstatements or less misstatements? Will it have more misstatements? Will it have more mistakes or less mistakes? Yes, more mistakes, right? Now, when you know, let's say this is our financial statement which the management has given to me. I know that this financial, because the controls in the organization are not good, this financials will have mistakes. I am sure, I basically feel that the chances of material misstatement is high. Now, as an auditor, please tell me, extent of my work, you don't have to note it down, I'll just tell you when you have to note it down. Okay, extent of my work as in extent of auditor's work. Please understand, I just want to ask you, I assessed internal controls is not adequate, and because of which I have assessed that I know that the chances of material misstatements are high. That means this financial statement will have more misstatements. Now, your work as an auditor, will it increase or decrease? Your work as an auditor, because you now know somehow that this financial statements contains misstatements, will you have to resort to extensive checking, in-depth checking? Will you have to put in more time to audit the financial statement? Yes or no? Yes. So can I now say the extent of audit work will be more here? Okay. On the other hand, when I assess, okay, this organization, they have amazing internal controls, superb internal controls. Because they have amazing internal controls in place, the chances of financial statements being misstated is very low. I know that there cannot be much mistakes in the financial statement. So automatically, what is going to happen? The extent of my work here will be what? Are you able to understand? Obviously, now please understand. Obviously, the fees that you are going to get as an auditor, let's say it is fixed at 10,000 rupees. The fees which we get is, let's fix as 10,000 rupees. Now, in which of the two scenarios will you be more happy as an auditor? Second scenario, Kritika is saying in the second scenario, Kritika, you are only going to get 10,000 rupees and you have to do more also. Okay, so the first scenario, all right, okay. Now, when the controls are adequate, obviously, we know that the chances of misstatements will be less. And accordingly, if I'm just extending the relation, and if the chances of misstatement is less, obviously, the extent of work that I'm going to do, it is going to be relatively less. And I'll be more happy because I'll be getting the fees. Even though, obviously, by doing less work, I'll be getting the fees. Okay. Now, a very important point that I want all of you to understand is, again, I'm just asking you, what is the work of the auditor? What does an auditor do? What does an auditor do? Please tell me this. I want you to answer this. Does he give an opinion? Yes or no? Does the auditor give an opinion? He gives an opinion on what? He gives an opinion on what? Absolutely. He gives an opinion only on financial statements. Please understand this. The auditor's responsibility is only to give opinion on the financial statement. What kind of opinion does he give? Yes, please. What kind of? Yeah, whether the financial statements are giving true and fair view. This is what the auditor has to do. Please remember, now, while the auditor is auditing, please understand, now while the auditor is auditing, whether he is going to assess the internal controls of the organization or not. Yes, okay. He is going to assess the internal controls of the organization, but please remember, he is only going to assess the internal controls of the organization to determine how much work he has to do. He is only going to assess the internal controls of the organization to ultimately determine how much work he has to do. Nowhere in audit he is required to give an opinion about the effectiveness of internal controls. He is not supposed to comment, he is not supposed to give an opinion whether the internal controls of the organization is adequate or not. He is only going to give an opinion on the financial statements. Please understand this. He assesses the internal controls, but he is nowhere required to give an opinion on the internal controls. Why is he assessing the internal controls then? He is assessing the internal controls only to determine the chances of misstatements, and accordingly he will be able to determine the extent of work which he has to do. Have you understood this point? This is a very, very important point. Is it clear to everyone? So now if I go to Shri Mithai in Chennai, and if I am the auditor of Shri Mithai, I am nowhere in my audit report going to say that their controls are effective or adequate. I am just going to say whether their financial statements are giving true and fair view or not. But do I need to assess their controls or not? Yes, I need to assess their controls. Why do I need to assess their controls? Sir, to determine the chances of misstatements. Okay, and if, sir, the chances of misstatement is low, probably I'll be more happy because the extent of my work will be relatively less. It is only for this reason, it is only for the auditor to determine the quantum of work, to determine the extent of his work. He basically assesses the internal controls. Is this clear to you, everyone? Yes. Okay. All right. Now, if this is clear, let us just link few topics now. Now, let's say if the auditor finds that the internal controls in the organization are adequate. Okay. So if the internal controls are adequate, can I say the reliability of financial statements, will it be high or low? If internal controls are adequate, reliability will be high. This means chances of misstatement would be high or low? Would be low. Okay. All right. So the chances of misstatements would be low. Okay. Now, when the chances of misstatements would be low, now auditor's extent of work would be low. Low as in less. We are going to say less. Okay. All right. So this is just one aspect. I am going to extend this relationship. We are going to discuss in terms of technical terms later. Okay. But this is just a relation that I wanted all of you to understand. Okay. Now, when I've been using this word again and again, chances of material misstatement rather, I should have used chances of material misstatement, okay, because I told you auditor is concerned with only material misstatements, okay. So when I say internal control is adequate, I say reliability of financial statements is going to be high, then the chances of material misstatement is going to be low. Now technically this word, chances of misstatement, probability of misstatement, the likelihood of misstatements happening in the financials of the organization, we call it as, technically in auditing we call it as something called risk of material misstatement. In short, I will be calling it as ROMMS, risk of material misstatement. Okay, when I say chances of misstatement, this is just in terms of a layman. When I talk in terms of auditing, in technical terms, I will always be calling this as risk of material misstatement. So in short, now can I say if internal controls are adequate, ROMMS will be what? In short, ROMMS will be less. So can I say there is an inverse relationship between internal controls and ROMMS? Yes? Okay. Alright. Now what is ROMMS? I have just discussed the word. Let us read this word. We have this word here in the definition. Okay. Yes. This is internal control here. Let us read this, and then we have a risk of material misstatement also. Okay. Now, let me complete the internal control definition first. Internal control, it is a process when I say process, you can also write, you have learnt in EIS also, it can be policy, it can be procedures. Okay, so internal control is a policy, procedure, or a process put in place by the management to prevent, detect and timely correct material misstatements due to fraud and error. You all know that misstatements can happen only because of two reasons, either due to fraud or due to error. When misstatement is done intentionally, we call it as fraud. When it is unintentional, we call it as error. Okay, now management is responsible. You all know, I've already told you this, that it is the management who is ultimately responsible for three words. Remember the three words, okay? Design, implementation and maintenance of system of internal controls. Internal controls is the responsibility of the management, okay? Preparation of financial statement is the responsibility of the management. Many people think that if they hire a chartered accountant, if they appoint an auditor, it is the auditor's duty to prepare the financial statements. No, it is the management's responsibility to prepare the financial statements. We just go and check whether management has prepared their financials as per the applicable FRF or not, whether the financials are free from material misstatement or not. And of course, if it is free from material misstatement, it will be free from material misstatement. We'll say that yes, financials are giving true and fair view. Okay, so now let us understand what is risk of material misstatement. Now, the risk of material misstatement refers to the risk that financial statements are materially misstated and do not present a true and fair view. The risk, that means the chances, the probability, the likelihood that the financial statements are materially misstated and do not present true and fair view. This we will be calling it as risk of material misstatements. Is this clear to you or not? Okay, now just one example, I just want you to answer this question. Okay, now okay, let's take two examples. Okay, one is a jewelry business, and one business A, and let's say business B. They deal in stationery, office stationery. Okay, now, out of these two businesses, I'm just asking you very generally, okay? You are the auditor, okay? You know nothing about the entities as such. You only know the industries to which they belong. So let's say client A belongs to jewelry industry, client B belongs to stationery industry, wherein they sell copies and registers, etc. The office stationery, etc. I'm just asking you a question. Out of these two businesses, where do you feel that ROMMS can be high? Chances of misstatement can be high. I'm just asking you, where do you think that ROMMS can be high? Sorry? In stationery business, okay. Venkat says stationery. Sanjay, what were you saying? Stationery, okay. Alright, so can you please tell me the reason also? No, I haven't. I have. Yeah, okay. You have gone a bit too deep. Okay, let's assume that there are no internal controls now. Let's assume there are no internal controls. I'm just asking you randomly, out of these two businesses, where do you think that chances of misstatements happening in the financials, as in chances of errors or let's say frauds happening in the financial statements, will be high? Okay, small number of transactions. All right, okay. Now let's say, okay, this perspective is also correct, that stationery being a small shop, let's say small business, number of transactions will be very high and misstatements will be there. But I am asking you, ROMMS, risk of material misstatements. See, as an auditor, will never be concerned with all the misstatements, will be bothered with material misstatements. Okay, now try and understand my perspective on this. Okay, now I feel that the chances of risk of material misstatement in jewelry business is going to be high. Chances of misstatement. Why? Because let's talk about gold. What if the jeweler has purchased gold at a low price? Okay, because the price keeps on fluctuating, and he has sold at a high price, but he shows that the purchase was made, let's say, at a higher price, as in, let's say he keeps on purchasing at low price also, at average price also, at high price also. He made a sales, okay, but corresponding to the sales, he'll show a high purchase. Why? So that the profit comes down. Can this be done? And as an auditor will not be, this can be done, and as an auditor probably will not be able to find it out. Okay, so what I'm trying to say is, because of the fluctuations in the value of the sales and purchase, the chances of financial statements being materially being misstated is relatively high in case of jewelry. But on the other hand, in case of stationery business, in case of books, business of books, copies, etc., the price is stationary. The price hardly changes. They purchase at the fixed price, they sell it at MRP. So the chances of misstatements happening in case of stationery business is very low. Okay, but I have just told you one aspect. You feel that ROMS may be high, but what if the jewelry brand is a very big brand, and they have superb internal controls in place? If they have amazing internal controls in place, ROMS will be what? Less. Yes, okay. Now let us say that in this stationery business also, if they have very less internal controls, again the ROMS will be what? High. So what I'm trying to tell you is, we generally, the first thing that we go and do in an audit, we are going to discuss this in our next session. The first thing that we go and do in an audit is basically we try to gain an understanding of their internal controls, so that we have an idea about the ROMS. And when we have an idea about ROMS, the chances of financial statements being misstated, we accordingly plan our work. Now imagine jewelry business. Let's say that this stationery business has very high ROMS. I'm just assuming, okay? I'm just assuming that it has got very high risk of material misstatement. I told you that now your workload will be more or less. As an auditor, your workload will be more or less. More, okay? And accordingly, we need to plan. So this internal control and ROMS, understanding of these two aspects is really, really very important. And only upon gaining an understanding of these two aspects, we actually start our audit. We actually know now ki, okay, these are the areas where there can be higher chances of misstatement. These are the areas, purchases, we need to check thoroughly. Accordingly, we plan our audit. So these two terms are really, really very important. Okay, so now for today's session, okay, just let me just summarize few things. Okay, we started with something called as financial statements. Okay, you know, financial statement consists of balance sheet, PL, cash flow statement, equity changes, statement of changes in equity, and notes to accounts. Okay, this financial statement is prepared by whom? The management, and they use something called as what? FRF in preparing the financial statements. Yes, okay. Now also management implements certain internal controls also. Now internal controls again is the responsibility of management. Okay, now these financial statements are actually used by whom? There are users. They are used by users, but these users, they cannot place reliance on the financial statements. Hence auditing is done. Auditing of what? The financial statements. Okay, auditing of financial statements is done, and this auditing provides users what? Ultimately assurance. Okay, yes. Now when I am auditing the financial statements, prepared by the management, will I also assess internal control or not? Yes, I will assess internal control only for the gaining an understanding of ROMS, and accordingly I will do the auditing work. So these are the terms that we discussed. Don't draw this diagram. In the next session, I will make you draw a very once we are done with few more terms, we will draw a extended diagram. Okay, but when I talk about auditing, in auditing, what is the responsibility of the auditor? To give what? An opinion on the financial statement. What kind of opinion? Whether the financial statements are giving true and fair view or not. When will a financial statement give a true and fair view? Only when the financial statements are free from material misstatement. Okay, and you all know that what is the reason for misstatements happening in the organization? Misstatements can occur only because of what? Either a fraud or error. Okay, so these are the terms that we have covered in our today's session. Okay, now these are the basics. Again, I'm telling you, no question as such will be asked from this part, but again, it is important for understanding the remaining chapters, all the chapters. Okay, now I want all of you to keep one copy for auditing. Like in EIS, I never make the students write, but in auditing, we'll be writing some aspects also. So around by the end of this session, you'll around 100 to 120 pages, 80 to 100 pages probably will write. Okay, I'll in few cases I'll make you understand certain concepts using the help of diagrams. Okay, I'll ask you when you have to take a note of it. Okay, and in certain chapters, okay, I told you that we are going to discuss some standards on auditing with certain chapters. Okay, some standards. So many standards probably I'll make you write handwritten notes. I'll write the notes and you'll see able to see it on the screen. I'll ask you to copy it down. Okay, so what I'll do is the ones who will be watching it later in the recorded sessions, obviously they can pause the video and take a note of it. Okay, and the ones who are watching it live, I'll explain you through my notes, through my handwritten notes, and I'll share the PDF with you in the app. You can copy it later if you want. Okay, but yes, why I'm doing this, because I feel, in auditing it is very scoring, but at the same time in auditing, what happens if you ask your seniors also, you need to understand how to write the answers, how to develop that quality language. Okay, so when I make you write some standards and all, and when you go through your own handwritten notes, it becomes very easy for you to understand. Okay, and if you talk to your seniors, okay, if some of the old batches students are also there, okay, everyone, if you talk to the seniors, they'll say you that standards on auditing are very dangerous. You have to understand, at least there are, let's say, 35-36 standards you have to cover, and the standards on auditing, students generally tend to study these as in at last. Okay, or they tend to ignore this topic, but trust me on this, standards on auditing is my strong point, and I'm very sure that this is something that you are going to fall in love with. Okay, so I'm going to make you write certain notes of standards on auditing, which will make the standards very easy for you to understand and learn as well. Okay, so along with each chapters, we are going to cover certain standards also. Okay, and we have company audit, etc. I'll make you, I just told you that I'll basically try and summarize everything, and at relevant areas I'll make you write it in the copy, so that when you go through the copy, it is you'll be able to revise it through your copy really very fast. Okay, so let us wind up today's session. This is it for the day. Okay, now